Oh yeah, by the way, it is being recorded. Just waiting for a few more people to join, and sure. Right now, so we'll kick off. Welcome to the first of a series of virtual panel interviews that I'll be doing during the course of this year, and we're very grateful for experts, shall I call them that, in our from our lender partners. We've got Matt Martin, head of national accounts from Virgin Money. Another Matt Kingston from the Nottingham, who's head of national sales, and Chris Blewitt from the Darlington, who's head of mortgage distribution. Ian Andrews from the Nationwide will be joining us. He's having a few technical issues at the moment, so hopefully he'll be with us shortly. But to start off today, what I would just want to position with any questions that may come in through the Q&A section of the Zoom, is that we're probably not going to touch on, well, in fact, I know we're not going to touch on the recent news of the Nationwide and Virgin Money merger. I don't really think that we're going to get much of a response from Matt or Ian when he joins on that topic, because it's early days. It will probably be business as usual. So we probably know as much as they do from what they're seeing in the press at this moment in time. So if we have got any questions, by all means you can put them in the Q&A. But if we can avoid that topic, because I don't think you'll get an answer other than it's business as usual at this moment in time. So if we can keep the Q&A down to topics that we've discussed. So if we move on to the start, we're going to start off with a quick question for the audience. If we can get the poll question to come up, and if we could get your answers, and then we'll move on to the first question to the panel. First panel question. Yeah. So, do you think the recent changes in the budget announcement will make a significant difference to affordability for your clients? Will it improve affordability, no change, or reduce affordability? Still waiting for a few more respondents. more. Still waiting. Okay, I think we'll finish it there. So we've got 94% of you think there'll be no change, and 6% think there'll be reduced affordability. So on that topic of affordability, for the panel, last year's affordability was a challenge for most brokers. And what signs are there of this improving in 2024? And what are you doing to make mortgages more affordable to more customers? So, should we start off there with you, Matt, at Virgin?
Yeah, sure, no problem. Thanks, Rob. Morning, everyone. So look, I think the good news is that from an inflation point of view, we've seen inflation starting to fall as announced earlier this week. And so we know that prices will start to rise less quickly. I think that's the really important part, that the cost of goods will rise less quickly. Hopefully then from a consumer point of view, that's really good news. If I think about it more from a lender point of view, we need to make sure we find the right balance. So that's being competitive and factoring in stress rates behind the scenes, just making sure that we're protecting customers as well as lending to customers. It feels like there's some real positivity in the market, and I'm pretty confident everyone on the call, both as us as a panel of lenders and advisors, will have noticed that. That said, there's no denying that it still remains tough for advisors. We're aware that there are clearly challenges that remain around deposits, affordability, stress rates. But what we're doing our best to help in supporting brokers and their customers to overcome those challenges. And hopefully what we've had are examples of advisors on this call having benefited from our innovation and motivation to keep kind of disrupting the mortgage market. And I guess we're all keen as lenders on this panel for that to continue. So a couple of the more obvious things that spring to mind from our point of view are enhanced affordability improvements where it comes to 5-year fixed rates, and also smaller things like just extending terms from 35 to 40 years, which can make a real difference to a customer's affordability. Just yesterday as well, we made a number of improvements. One of them that should really help from an affordability point of view, and that's moving to second incomes, accepting 100% rather than 50%. So I think as we move through the year, we'll see tweaks like that and various moves from lenders that will help customers. We've tried to take it a step further. We've also mixed things up in terms of lending on the more complex scenarios. We're saying yes to more scenarios that don't just tick a policy or affordability box. And I think what I'd really encourage advisors on the call to do is to pick up the phone to their BDMs to talk more about this. Whilst on the face of it that we as a lender lend purely based on policy, we really are in a good position to lend based on the more complex scenarios, both policy but also affordability. So it's about having those great relationships with BDMs. Plus, then if you look a little further, you look at products and innovation like Own You that we're kind of proud to be part of. For those that are new build brokers on the call, from an affordability point of view, where we're able to offer rates that started off at sub 1%, where a developer is able to put some cash into the transaction, that makes a significant difference to the customer's affordability for a mortgage. So I think there's lots of good things that will start and continue to take place throughout the year, Rob.
Thanks for that. Chris, from the Darlington, what's your views on that?
Yeah, so I think the budget itself, kind of split it into two, Rob. The budget itself probably didn't do a great deal, if we're honest with you. We're getting kind of 2% back in our national insurance, but then you've got the fiscal drag, which probably means you don't see most of that. But there are other positives coming out. We'll have all got our letters saying our fuel bills are going to be coming down, the price caps dropped. And I think the other side of it is, Matt hit the nail on the head with price rises slowing. Hopefully that's going to be coupled with pay rises coming in people's kind of April or May pay slips. So hopefully over the kind of next 6 to 8 weeks, we might just see a little bit of a balancing. I think without anybody doing anything, there'll hopefully be a little bit of a balancing there in affordability. I think back to Matt's point, unfortunately, the affordability challenge is twofold, isn't it? It's the stress rate, which is causing as much problem as actual the affordable cash in hand. But again, there was some really positive news out yesterday. I know bank rate kind of stayed the same, but there's definitely an indication that that's going to be coming down in the middle to kind of longer term. I haven't seen swaps this morning, but I don't know, we might be touching a bit on kind of pricing models later on in swaps, but hopefully that's had a positive impact as well, which will allow people to start just thinking a little bit more positive kind of long term. You know, I think from our perspective and certainly advisors that we work closely with, this year's not been the terrible start that everybody thought it would. You know, if you watch the news or read a newspaper, you know, it's all doom and gloom. But there's nothing out there suggesting that's the case at all. It's not boom time, certainly not boom time. But there's no reason to be negative. And again, you know, keep echoing Matt's points, but lenders are working really, really hard to solve the problems. But it's an evolving landscape, and I think people just need to understand the pressure that the lenders are under as well around responsible lending. You know, we'd all love to stress at a really low rate. That means we all say yes, but there's no point putting keys in hand today that we then take back off them tomorrow because we've got it wrong. So there is a balance to strike with affordability.
Matt at the Nottingham.
Yeah, morning everyone. Yeah, it has been a challenging time for customers and brokers, isn't it, last year? I mean, a lot of the changes that we made were specifically designed to help customers with affordability and give brokers an additional option to come our way, really. So we increased the LTI to 5.5 times, and that's made a real difference, I think. We've also made our calculator more accessible to third parties so that more people can see that the Nottingham have got something to offer. I think the other thing I would add is that we've seen quite a big increase in interest only as well. So I think where customers perhaps affordability has become a stretch, it's not going to be the solution for everybody, but interest only isn't that additional option, which might mean that a customer can stay in their property and keep their bills down a bit more as well. So yeah, I think we've seen a fourfold increase in interest only, both for customers that have got an exit further down the line or just need a bit of an interim measure really to get them over this affordability hump at the moment. But yeah, I think as you know, both Chris and Matt have said, lenders are working so hard at the moment just to try and, you know, provide some options for brokers. So yeah.
And good morning, Ian.
Yeah, well, Rob. Sorry, I'm late. It's a good example of what happens when old guys try and use technology.
We were touching on the first question about affordability. So I don't know if you've heard what the lads have said, but is it worth anything from the Nationwide?
I think the guys have probably covers it, Rob. You know, clearly it's been difficult. I think it's getting better. You know, the inflationary figures were pleasing during the week there. Swaps have moved down, and we're not quite out the woods yet, but it does look as though we're going to, things are settling down. And I guess we'll get into an interest rate environment which won't be the same as it has been for the past few years, but will become the new normal, and everybody will just, accept that. Customers, lenders, brokers will just accept that and find ways around it. So it does feel as though things are easing a little bit, but clearly it's been a challenging time. And Nationwide, I guess, probably the best thing we've done is a helping hand, which gives first-time buyers access to higher levels of affordability. That's been a roaring success for us. But obviously, when you listen to the other guys talking, clearly all lenders are trying to find solutions to help the industry and help brokers.
Yeah. Do you think that with a slight easing in affordability, we'll see more remortgages than
I think
with the maturities coming up?
Yeah, I think that is definitely the case. So I think the remortgage market should start to recover as we see interest rates coming down. The energy price cap's due to be reviewed. Is it next month or the month after? So that again should help household budgets, should help the inflationary figures. So it does feel as though we're through the worst of it, and there will be a gradual improvement.
Well, I mentioned product transfers there. So I mean, we saw more intermediaries doing product transfers last year than previously. But the level of work that an advisor does on one of them is on a par with a new business case. So why haven't we seen more lenders acknowledging that and raise the level of proc fees on PTs? Ian, do you want to start off with that one?
Yeah, sure.
We'll hear from the others.
Yeah, thanks for that. Thanks for that hospital pastoral. Yeah, I mean, listen, you know, I can only speak for Nationwide clearly, but there are a number of reasons why our procuration fee level for product transfers are pegged where they are. You know, I'll quickly run through them. We have customers maturing from 2 and 5 year fixed rates, where margins were far stronger than the products that they're maturing onto. So I guess that's one aspect of it. We've got a price promise for our existing customers that we won't charge them more than new customers. So it would be completely against their mutual ethos to start charging more for product transfers than we do for new customers. And, you know, that's a way that, you know, some lenders generate higher revenue to pay higher levels of procuration fee. We just couldn't do that. Our current retention rates are over 80%. So currently 4 out of 5 customers choose to stay at Nationwide at the end of the maturity. So clearly you end up baking in a load of cost for business that you're getting anyway. And I guess the other thing is the competitive position. You know, we have a procuration fee review group which meets regularly to review front-end procuration fees and retention procuration fees, and part of that is competitor analysis and activity. And at the moment, the vast majority of our principal competitors are in the same place as us. So, you know, it's not a case of never say never, but, you know, for all those reasons, we're relatively comfortable with the current position, and, you know, we'll keep things under review, and clearly if things change, then we'll come out to the market. But it is a burning issue just now, and, you know, the TMA members, I guess, should be aware that all distributors are putting pressure on lenders. You know, met with Rob Sinclair of AMA last week. He's in exactly the same position. So there's certainly a build up of pressure, but I think we have reasons where we can justify pegging our level where we are at the moment.
Okay. Chris at the Darlington, I think you did make a slight change.
Yeah, so I mean, this is the opposite of a hospital path, isn't it? This is kind of like teed up for me to knock it out of the park. So yeah, we've recently moved to 0.3 for retention. In fairness, I was pushing against a little bit of an open door internally. We've kind of kept it under review. We were at 0.2 for a little while. I think it probably goes back to the point you made, Rob. You know, if you think about a remortgage file and you think about a product transfer file, everything is identical up until the bit where you hit submit. And personally, once you hit submit, the remortgage file continues to grow. The PT file does, but at a lesser rate. There's not the kind of ongoing conveyancing, dealing, and everything else. Which is why we settled on 0.3 as opposed to the slightly higher that we pay for acquisition. I think it's only right to acknowledge the work that our broker partners do. You know, in my role, I look after both intermediary and direct, and I suppose ultimately I only care about the member outcome. But in 95% of cases of our business, the member outcome is delivered by our intermediary partners, and therefore they're my customers as well. So I need to make sure I'm doing a good service by them and recognise the good service they do for us. So yeah, I think it's important that we protect them in this time and pay them fairly.
And Matt at the Nottingham, I think it was the other side of Christmas, wasn't it, when you made some changes to some of yours, didn't you?
Yeah, we are doing quite a big review of our proc fees at the moment, and we increased our sort of retention proc fee to 0.3 in September, but we're continuing to monitor all of our proc fees, because some of them are a little bit all over the place at the moment. So but yeah, as Chris said, the advice process is the same regardless of the outcome, whether it's a remo or a product transfer. 100% of our new business is intermediated, so we're completely partnering with brokers from a new business perspective, and I guess in fairness, I would say, I agree with you, Rob, that there should be parity between the new business proc fee and the retention proc fee, and I think that's probably the direction of travel, and that's certainly something that I would advocate as well. So we'll see what happens, but yeah, we'll keep trying for you, Rob.
And Matt at Virgin, finally, I think you've got a slightly different angle on this, haven't you?
Yeah, I mean, I'll start this just by saying, if I look back, I think it's always useful to sit back and look at the journey we've been on. And I remember when I first landed in the industry, it was 04, 05, something like that. I know I don't look old enough, but I remember brokers contacting call centres and just trying to find out what rate a customer could apply for themselves, let alone the broker actually doing that on the customer's behalf. So I think we've come on such a long journey that we should acknowledge that. From a if I look at Virgin Money point of view, we don't pay a full proc fee on PTs, but we do pay an above average 38 bips. But I can't really take the high ground because in Clydesdale we sit at 20 bips. To make any increase to proc fees, it's extremely difficult, especially at the moment, as I think we've kind of touched on, due to margins being squeezed tighter than they ever have done. And businesses, large or small, whether you are a lender or a broker, being impacted. And I think on that point, the big thing for us is investment within the intermediary channel. We really want to be able to ensure that we're supporting advisors and your customers in what the future of what the market looks like. And whether that's tackling and developing proposition, which supports affordability, through to understanding, new home scheme innovation. I think Chris touched on it, but what we can do is help to support with the process. And so, our BDMs are actively involved in the process and making it as pain-free from advisors and customers as possible.
All right. Well, it's a watch this space, and I'm sure our key account managers will be getting feedback from brokers asking about when will the fees go up, are they going to go up or anything like that. So you can rest assured that we'll be feeding back through your key account managers as well what brokers are telling us.
I think, as I said, Rob, I think everybody's aware of the pressure. It's it's one of the burning issues in the market at the moment. I think as lenders, there's maybe other ways that we can look to try and ease the pressure on brokers, and that's something that we're looking at the moment.
Yeah. Okay. Excellent. Let's move on to the funding of the products. First of all of you on the panel probably fund from retail savings, as well as a little dabble into the markets as and when you need to. As rates rose last year, have your savings rates increased by the same rate? And if not, why not? And do swap rates have an influence on your mortgage rates more so than the savings? And is it the same as the other lenders who don't have retail deposits? Shall we start? Who should we go to first there? So let's go to Chris first. What's your situation there?
Cheers, Rob. So, I mean, in fairness, we work quite closely with our treasury department. So I think I can probably, there's about 3 or 4 questions, I think, almost in one here. Isn't it? So the first part is, yes, as rates rose, we increased our savings rate. So we're a mutual. We're not here at all to maximise profit. There's a bit of a soundbite here, but it's kind of about optimising that profit. So that gets nicely passed on to our members in terms of savings. And I think we kind of published our figures at the end of the year last year that our savers got something like £2.5 million more in interest by being with us than the market average. So if they kind of had it out there, which is again kind of nice to kind of do. I think in terms of swap rates, though, the answer is still yes. So although we are, retail deposit funded, if we lend on a fixed rate, in terms of a balance sheet, and if there's anybody from our treasury department listening, I'm hoping I'm getting this right. But in terms of it, we don't want a fixed rate on the balance sheet. We can't. So we hedge it against that and effectively swap it back so we get a variable rate of income against kind of the lending. So in short, Rob, yes, we are still very, very concerned about swap rates when it comes to our pricing model. Purely because we swap the fixed rate for the variable rate, which makes it easier to manage from a treasury perspective. Okay. I can't go into any more detail because I don't know any more detail. Yeah, cheers. I think it's the right answer as well. Hopefully I've done our treasury guys proud.
Matt at Virgin, what's been happening there?
Yeah, it's a great question. I mean, look, we typically don't discuss pricing of specific products because it's commercially sensitive. But I guess, yeah, in broad terms, we fund, you're right, in that we fund our mortgages from a variety of funding sources, including retail and business deposits and wholesale funding, each of, varying durations and costs. And, it's for somebody far above my pay grade, as it's far, far more complex than I've just made out in the space of a line. And on the savings point, you'll have seen savings rates increase as base rates have increased. And you'll have seen that in pricings of savings, products have too. So, for example, at the moment, I'm well aware that there's an ISA in the ISA market at the moment. Virgin Money have a 5.25% 1-year fixed rate cash ISA. And I believe that's, relatively well priced against, its competitors as well. So, look, for pricing mortgages, the specifics, again, like I say, commercially sensitive, so I can't comment in too much detail. but as you'd expect, decisions are made with considerations to the overall cost of funding, swap rates, competition, risk appetite, and our target returns, not forgetting, you know, we make these decisions based on our operations teams and the service that any change could have on as an impact to brokers and customers.
Matt at the Nottingham.
Yeah, so this is the first, I've been with the Nottingham for 12 months. It's the first building society I've worked for, and yeah, it's a much simpler way of funding than perhaps in the wholesale market. So, you know, we're in pretty good shape at the moment. We've got money to lend. I think the only perhaps thing that prevents us lending more is capacity within operations, to be honest. But we're able to sort of grow the mortgage book organically, but also inorganically through our partnerships with like Generation Home, and we fund their mortgages as well. I think when I spoke to the Treasury guys ahead of this call, it was kind of like from a savings perspective, we see a lot more variable rates, so that's more susceptible to bank base rate. Whereas our mortgages are primarily fixed, and I think yeah, all I would say is whilst we keep an eye on swap rates, we just don't want to make sure we're too exposed, so we get swamped with volume. So we keep an eye on swaps, but we're less reliant on swaps when it comes to our pricing.
And any nationwide, I presume that what with the Mortgage Works brand as well, it's a bit of a mix, really.
Yeah, there's a mix, but ultimately pricing is ultimately driven by swap rates, and I think Chris has covered it off really well. The reasons why every morning we're looking at the swap rates and how they're going to unfold during the course of the day, and that's what's factored into mortgage pricing decisions. So it's almost regardless of how much you're raising through your retail funding, your pricing is driven by swap rates, because of the the example that Chris gave there, and it's swap, and that's why you see swap rates coming down and mortgage pricing coming down in the back of it, Rob.
Okay. We've had a question actually in on swap rates from Michael Norwood, who says he understands about swap rates and how they affect mortgages, but can you explain why SVRs are still so high with the lenders? Ian, have you got a view on that?
Well, I mean, it's clearly driven by bank base rate, isn't it? So when bank base rate goes up, SVR tends to go up on the back of that. So that would be the main reason for that. Rob, we would be quite happy to run a session for your members. If you want to get something, why don't we try and get somebody from our Treasury team to come in and run a session for your members, just to take some questions from them on swap rates and general funding, and cover in a bit more detail than we've got time to do today. I'm quite happy to take that offline and try and set that up.
Yeah, all right, we'll try and sort something on that. Thank you for that, Ian. Thank you. Let's turn to buy-to-let. What, Ian? We'll start off with you, Ian. What do you see as the main challenges that landlords are facing? Is it down to the rental calculations, or is there something else? And what do you think of the high product fees that we've been seeing in the buy-to-let market?
So I think the main challenges, I think, have been the taxation changes, clearly, which have driven a reduced benefit to landlords. The regulatory changes which have came in, which have baked cost into the market, and then of course you've got the affordability issues, through stress rates, a general tightening in the market, some buy-to-let providers disappearing completely, some significantly withdrawing the number of products that they've got available and their appetite to lend. So there's been quite significant challenges across a number of different areas, and as a result of that, obviously we've seen a number of, I guess you would class them as small sort of amateur landlords deciding to leave the market and sell at the end of tenancy agreements and so on. That's certainly what we've seen, although we're not really seeing that in the more professional landlord space. In terms of the high fee products, we launched a couple of them last year. We launched a percentage product, and we launched a fixed fee, quite a high fixed fee product, which obviously allows us to set lower interest rates, which helps with affordability. I have to say, out of the two of those products, the high fixed fee product has been significantly more. We're so significantly more on that than we have on the percentage fee product. And we've also driven in, as well as driven in quite a high volume on that. For the average loan size is significantly higher than the average loan size as well. So there seems to be the appetite for it based on our experience and based on the volume that we've achieved, but more on the fixed rate side and the percentage fee side.
Chris, is that something that you've got a view on with the high fees in the buy-to-let?
Yeah, it's not something that we've kind of played with. I think it's gaming the system, isn't it? You know, I think let's be very, very clear on what it does. It allows you to get around that kind of high stress coverage ratio. And I think as long as the end consumer is comfortable with front loading, I don't see an issue with it personally. I think the only concern I would have is, and I hope this isn't the case, but if we do stay in a high rate environment over a longer period of time, and they're adding this fee onto the mortgage, assuming the lender's letting them do that, at what point do they run out of equity to do so, and then they're actually just stuck? So, you know, I think it's really important that they seek advice on this and they talk to their mortgage broker about this transaction, but actually what does that mean for future ones? Because you can't just keep kicking this can of a non-profitable buy-to-let property down the road continually. At some point, that's going to come back and bite you. But everything else Ian said is exactly right. You know, I think landlords have been demonized is a strong word, but maybe a fair word in this scenario. And if you look back over the last 6 to 8 years, what's been clear is as housing targets, there's obviously now no housing targets, but as they fail continuously to have been met, the requirement for good quality homes through the buy-to-let space has been evident. And it's almost now like, well, that's, like I said, they're being pushed out, and that really worries me. And I'm comfortable, you know, from a, I suppose, ethical perspective with moving them into kind of limited companies. That feels fine. I worry where that ends, because I would not like to see a world or a UK housing market where we have big national corporate landlords who don't know their tenants, who don't know the properties that these people are making homes out of, but they just manage via a spreadsheet and profit. And, you know, in my experience, when business gets too big, that's what it becomes about. And these amateur landlords, to Ian's point, there's a place for them. The people who can go around at a drop of a hat and help fix the boiler and change a light bulb and make sure that the home stays a home. I'd be really worried that these people get pushed out, because they're, like I say, they're needed to create good quality homes for people.
Yeah. Okay. Right. Well, I'm conscious of the time, so we'll move on from that, unless the other two have got a particular view on this. But still talking about buy-to-let though, Matt at Virgin, where do you see the opportunities in this market?
Yeah, so I think, yeah, despite everything that we've talked about, and I think that the challenges that landlords face are, it's interesting because we're probably seeing less regulatory change that is potentially disrupting the market, but we're almost in this perfect storm of a number of other things that Chris and Ian have kind of talked through in terms of the challenges for landlords. But I still think there are opportunities. You know, advisors are in a great place to support landlord customers because of the complexities of this market. You know, we know that limited company buy-to-let is becoming, you know, an ever-increasing part of the market. So we may well see new entrants into that space, and that isn't exclusive from our point of view. And again, I kind of go back to the point around innovation as well. I think lenders are still doing all they can. And whilst not specifically a buy-to-let product, we've got our fix and switch, which is a 5-year fixed rate with a 2-year ERC with affordability stressed at 5-year. You know, that's a really useful product that can be used by brokers and their landlords' customers, you know, for an advisor to have that in the back pocket. I think as well, the opportunities for advisors to provide that holistic advice. I think just being able to give advice at this point, keeping landlords up to date on regulatory change and market insights, just give landlords the best opportunity at making those decisions around their next steps. Key for me, stick close to your BDMs. Often they can provide insight about criteria and looking at scenarios outside the box that might not actually always be particularly obvious.
Matt at the Nottingham.
Yeah, so you know, what we're seeing a lot more limited company buy-to-let, and we've been amazed at the volumes that have come in so far this year on that. I think it's interesting. We lowered our rates and it had very little impact, but we lowered our stress rates, and that's made a significant impact. And you'll see an announcement on that next week. I mean, buy-to-let is roughly sort of a quarter of the business that we write at the Nottingham, but we're totally committed to that part of the business. We think that the private rental market is so important going forward, so we'll continue to be committed to it. I think what some of the trends we're seeing are certainly more refinancing, so more remortgages as opposed to product transfers that we saw last year. So we think there's a good opportunity for landlords to sort of remortgage as opposed to product transfer. And we're also seeing, because we do new landlords, new SPVs, we're seeing quite a few younger landlords come onto the market as well. So perhaps you don't have to be an owner occupier. So we're seeing quite a few just sort of dipping their toe into the property market through a buy to let initially as well. So that's been interesting.
Yeah. I want to move on to technology. Technology is playing a big part in the mortgage process. We're seeing a lot on the certainly on the broker side with CRM systems, product and criteria sourcing, etc. What technology improvements can we expect to see from lenders, and will it be this year? Matt at Nottingham, do you want to start with that?
Yeah, you've probably seen the recent announcement that we've partnered with a new tech provider in MCube, and I think what that will give us is a much more configurable system to be able to help the more complex sort of inquiries that we're starting to see. That said, tech is only ever going to be an enabler as opposed to a replacement of advice. So what we want to do is just sort of make our systems accessible to APIs and third parties, so that I think the portal will become perhaps less relevant in the mortgage journey, and all we want to do is just make it accessible for whatever systems that brokers want to use. It can link nicely in with the systems that we have. But yeah, I mean, in terms of the source insights, and we've now linked up our calculator to the likes of 27 Tech and Mortgage Broker Tools and some others. So yeah, definitely it's an enabler as opposed to sort of robo advice with the complexity now of the inquiries that we're seeing.
Ian, being a partner with a major sourcing system, is there anything that you're looking at technology wise?
Well, I mean, for us, it's just about increasing the pace of delivery, Rob. So we've had a proportion of a proposition available through APIs at dip stage, and we've been piloting that with the various big sourcing systems for the last couple of years, and various distributors, including Primus. And the feedback on that's been really positive. So brokers like it. We reckon it's something like a 15 to 20 minute saving. Because of there's no duplication and pre-population, etc. But we need to build that 100% of our proposition out, and then we need to get we need to get the adoption rates up, and then we need to build it into product reservation, etc. So that's the path we're on at the moment. The sense for me is that the sort of pandemic blew a hole in everybody's technology plans. So that when that happened, there was budgets were scrutinised, other priorities cropped up. And that probably sort of derailed the industry, which looked as though that it was on a path to improving its technology. I think we're getting back there now, and I know that speaking to the sourcing systems and other fintechs that we're dealing with, there's a huge amount of momentum and investment going into it. Nationwide for us, really, it's about improving the customer and broker journey. So this is about taking as much friction out of the process as possible and giving the speed and certainty as much as possible. So, we're part of the way down the road. We'll be a bit further down the road by the end of this year, and then we'll be building out from that. We've got a clear pathway now. I'm quite confident that what is delivered will be better for brokers than the current system we've got, which is actually pretty good anyway. The other thing is there's a lot of third parties like Clydesdale, for example, who are building some momentum and have got some investment from lenders and input from lenders around trying to improve the back end of the process. And it kind of strikes me as that's probably the part where there's still a lot of friction around the sort of conveyance and valuation side. So it'll be really interesting to see how that develops as well. And if it does develop well, then we'll all benefit from it.
Matt at Virgin, is there anything happening at your end?
Yeah, well, look, I guess firstly to say we're on a bit of a journey in terms of our own application system. Despite that, though, as I'm sure most people on the call will know, we've worked with a couple of the larger sourcing systems in terms of integration from sourcing and CRM into our own kind of back office, which we've seen an increased uptake of. And look, we've done some research at the beginning of that, and advisors can save anywhere from sort of 30 minutes to 40 minutes without having to duplicate the information from their own fact finds onto our system. So that's been a real positive, and I think the take up of that will only increase as lenders get more and more into that. I think as well, just to put a different spin on this, I think it's really important that advisors take a look at how tech can help them. We've all debated will tech take over from brokers and will AI dominate the mortgage world? And I honestly, and I don't know if anyone believes it will, I think we've probably got a younger generation that thrives off the tech that's generally available if we look outside, the mortgage market. But, that's more about how we communicate with those customers, engage with them, update them, and keep in regular contact with them. Luckily enough, technology makes that easier than ever to foster those kind of long-term relationships with clients without it taking over, your working life. So, these tools don't have to be expensive. You will have already had CRM systems in your life, while other sort of approaches are free. So whether that be, social media scheduling and website analytics, and you don't need to do everything at once. This can be a journey from a tech point of view. Start small, develop your online communications as you go. And we're not talking about the need for you to become a content creator and the next big thing on TikTok. But I guess it can help. It's just looking at all those different tech angles and how can you make it work for you.
Chris, is there anything that as a building society that the Darlington are coming up with?
Yeah, so I mean, we are a building society, but we're probably more positioned in the kind of specialist building society space. So we do a lot of complicated and certainly quirky and nuanced cases. We've just finished our kind of implementation with Iris, so we're fully on their MSO platform, which will be familiar to a lot of brokers out there in terms of some of the bigger lenders who use them. And that's available for product transfers. I think it takes 5 clicks from client to kind of rate switch, and obviously acquisition as well. But what that allows us to do, and this goes back to Matt at the Nottingham's perspective, is it's an enabler. So the kind of nuanced cases that we see, it allows the underwriter to look where they need to look, not look where they don't, and therefore drag those timescales out unnecessarily. We've also recently gone live with their Lender Connect model, which is brilliant. So again, if you've got a CRM system or a sourcing system which plugs in, everything kind of populates in the decision in principle, which we're really proud of because, without kind of underselling ourselves, we're by far not the biggest lender out there. We are well and truly punching above our weight when it comes to tech. But that's based on broker feedback of we want to do the complicated, but it shouldn't be complicated to do it. So we've invested heavily to, I suppose, give a high street feel to that nuanced lending that we offer.
Finally, for today, expectations for 2024 are that gross lending will be similar to the levels we saw last year. That is around about 27 billion. Do you believe that it will be a fairly flat market? Or if not, what do you think it will look like and why? So let's start with you, Matt, at the Virgin.
Well, I ordered my crystal ball from Amazon, so I've got the answer.
Good.
No, look, it's interesting. If you look at the UK finance data, I think they're suggesting that gross lending is going to drop back from 226 billion last year to 215 billion this year. Look, we don't have any official forecasts ourselves, and we do tend to align ourselves with that UK finance forecast. But there will be numerous forecasts that will be published as the year progresses. But I think looking at that UK finance one, if them talking about a drop, I think a lot of that will be driven by the maturities opportunities that will be lower this year. Last year, our interpretation of maturities data was around the 342 billion mark, and this year that drops down to 295 billion, which naturally means less customers remortgaging, which impacts the gross lending figure. So it's almost this natural drop in the overall gross lending figure. But I guess back to the point, why are maturities dropping this year? Well, look, we all know the market saw a big demand in 5-year fixed rates over recent years. And so what's naturally happening is that customers who were due to end their fixed rate this year, if they're taken that 2-year, actually won't need to look at renewing for another 3 or so years. All that said, probably I want to focus on the positives. Let's break down the start of the year. Both January and February were really positive months. We know that 27 Tech in January, I think purchase searches were up something like 13% from the previous years. And if I remember rightly, they had their busiest day in January of over 100,000 searches since they started recording searches. February was also another, really busy month, and I think it would have overtaken January had it been for the fewer working days in February. So, look, sentiment was and is still there, and when you take into account the positive start we've had, gross lending could well be on track for a similar year to last year, and actually, perhaps even perform higher. But who really knows? For me, it's about control the controllables, stick to your plan, and kind of what will be, will be.
Yeah. Matt's at the Nottingham, your views on that?
Yeah, so I'll give you a number. No, I won't give you a number. But yeah, I mean, so we wrote more in 2023 than we did in 2022, and my target, has gone up again in 2024. So I think we're really optimistic from a Nottingham perspective that we're in good shape and be able to write more than we did last year. But it's going to be such an unpredictable year, isn't it, with elections and all sorts going on in the world. So it's probably harder to predict than it's ever been, with the traditional market norms kind of not really existing anymore, do they? So, but yeah, I'm going to go for 232. So you can quote me on that, Robert. All right.
Ian, can we have a view for the nice one? I know your financial year runs strange to the market. So
yes, so our year runs in the financial year, as you know, Rob. So all our forecasting runs in the financial year as well. So our forecast for the 24-25 financial year is 256. So it's quite a bit more, quite a bit higher than the UK Finance are estimating for the calendar year. Obviously, we're expecting things to pick up at the end of this year and roll into the quarter 1 2025. So I would reckon 38 billion, and that will be buy to let. The one thing I can guarantee is based on a
as he froze.
Oh,
Going so well.
I really wanted to know what that was.
Sorry, Ian, you froze for a minute then. We got the 38 billion that you thought was in buy to let, but we didn't catch anything after that.
Okay, I said the one thing I can guarantee is that we'll be reforecasting. These are the numbers that we're working all our targets of. So if that's the size of the market, what market share do we have an appetite for, and how do those targets flow through into the different channels? And we as you would imagine, we are constantly looking at the market, and quite often there is revised numbers coming out and flowing through, and I guess that won't be any different as we move into the next financial year. But at the moment, we're fairly bullish about the prospects of having a strong end to 2024 calendar year and a strong start to 2025.
Chris, finally.
Yeah, I'm not going to give a number. We don't look at the wider, and we're not big enough. I mean, if we took our percentage market share, it'd be crumbs as opposed to the cake. So we don't really look at the bigger number. We just look at what we're after. I'm positive about this year, though. I think back to Matt's kind of point, my expectations are higher this year than they were last. In terms of what's been requested of me, there's been a lot of headwinds, hasn't it? It's been very, there's been a lot of things going against the housing market, and yet it has still done very well. House prices are still, still buoyant despite those headwinds. Employment data is still very, very positive. So they're all the kind of ingredients needed, I think, for a strong year. The only thing kind of plays on my mind a little bit is that kind of post-COVID void. And I don't know how long that will last, in the sense of COVID, in my mind, sucked a lot of transactions forward. I think people moved in late 20 and into 2021 when it probably would have been moving 22, 23, 24, because the opportunity was right to do so. So there's a little bit of a lag there that we need to get over, I think. But I'm expecting a strong year from this year. Everything seems to be positive, except obviously a few little geopolitical things happening around the world, which unfortunately have a knock-on effect. But yeah, I think advisors should be very, very positive. There's an awful lot to go after out there, and when there's complexity, which there certainly is at the moment, there's uncertainty, it just proves the value of advice and the value of an intermediate mortgage market. So, you know, it might not feel like the sun's shining at the moment, but it definitely is in that need for advice. So brokers are front and centre, and certainly should be.
I mean, my personal opinion on this is that we, you know, if affordability does improve, we will see more in the gross lending than on the PTs, because some of those PTs won't be retained; they will be remortgaged. So I do think that it will be slightly, it may even be slightly up on what the UK finance forecast at the moment. I think it will be slightly up on that. I also think that when you look at the PTs as well, when you add overall, the overall size of the market is probably still going to be the same. So what we gain on the gross lending, we'll have lost in the rate switching. So I think that we're probably still looking at around about a total lending market of about 450, which was very similar to what we saw last year. You know, it's still going to be that sort of size. The one thing, and just a bit of a further forward, I would say for the brokers to be aware of, is that next June and September, there is 50 billion in each month of fixed rates maturing that we know of now, and coincides with 5 years since the stamp duty holidays, and you know that's where we're looking at. The second, you know, people doing 2-year fixed rates are probably on their second anniversary coming up. So you know, next year is going to be an even bigger maturity market that hopefully will be out of all the problems, and affordability will be better. But there's going to be that much more opportunities as we go in towards the back end of this year and early next. So you know, it's one to watch.
Definitely.
Well, that pretty much concludes all our questions. I've got a poll for the audience, so we'll just run that poll, and it's along the lines of what we just discussed about the size of the market. So we've heard what the esteemed panelists have told us. So where do you think the market is going to finish in the gross lending market? Is it between 200 and 212, 219, sorry, 220 to 250, or 250 and above? Running that, we'll see where that finishes. Another couple of seconds. A few more votes coming in still.
This is recorded, isn't it,
It
Robert?
is
So
indeed,
we'll
yes.
better play this back.
Yeah. Okay, I think we'll end it there. So I'll share the results so you can see there. 17% up to the 219, up to 250, 61%, and 251 or above, 22%.
Very positive.
Yeah, all positive.
Yeah.
Great for that. Thank you, everybody. Thank you to our esteemed panel, to Matt, Chris, and Ian. And as I say, this was the first of one of our panel sessions. There'll be another one in June and a further one in July. And I'll take away Ian's offer of getting a treasury spot for the swap rates. We'll progress that. We'll have a word in. So thank you, everybody. Thank you, everybody who's attended. And that concludes our virtual panel for today. Thank you.
Thanks, Robert. Thanks, everyone.
Thanks all.
Bye-bye. See you guys.